Every day we're introduced to new investments and philosophies on how to invest. But these new ideas are causing more financial damage than their financial incentives warrant. So let me share with you the exact investment philosophy that I use with my millionaire clients, including how we decide on a portfolio with the actual investments that make up that portfolio. Section 1, risk tolerance. The very first thing that I do when building out a portfolio for my clients is a risk tolerance questionnaire. Now, what I'm about to show you is actually the exact one that I use with my clients, and you can get it for completely free and with no email required in the description below. So the purpose of this questionnaire is to get an understanding of how my clients may react to a given specific set of circumstances. So take this question, for example. Imagine that in the past 3 months, the overall stock market lost 25% of its value. Now, an individual stock investment that you own also lost 25% of its value. What would you do? Sell everything, sell some shares, do absolutely nothing at all, or buy even more shares? This is an extremely important question for me to understand with my clients, but it's also important for you because the biggest mistake you could make is selling too soon and guaranteeing your losses. A couple of years ago, I attended a conference and heard Morgan Housel, he's the author of The Psychology of Money, say, my objective with investing isn't to maximize returns, but to maximize the likelihood that I stay invested. Now that quote really stuck with me because investing, honestly, a lot of the times just comes down to something as simple as not locking in your losses. Now, in return for maximizing your time in the market, you will thereby maximize your return given the risk profile and portfolio that you decided on, which is determined by the risk tolerance questionnaire that you actually just filled out. Now, before we move on to the next section, I just wanted to share one thing with you guys because I think this is absolutely crazy. And that is that 99% of Warren Buffett's wealth actually came after he turned 50 years old. So like I said before, sometimes time in the market really is the entire point of the game. Section 2, the philosophy. We now need to align our investment philosophy. Now at my business, we focus on low-cost ETF strategies that are aligned with your risk tolerance that have a primary focus of maximizing your time in the market, just like we discussed before. And honestly, for goals that are 2 or 3 years out, we won't even consider investing that money. We'll just put it in a high yield savings account or a money market fund. Now, as for the low cost ETF strategies, we use Vanguard as our preferred funds, but there are honestly so many low cost ETF companies that you can use, such as iShares by BlackRock or Charles Schwab. Now that we have our entire philosophy laid out, and yeah, it's really that simple, we can get into the structure of these portfolios or what funds that we actually want held within them. Section 3, the portfolios. We start by laying out each risk profile, which are aggressive, moderately moderate, moderately conservative, and conservative. Then we align those with an appropriate allocation. So aggressive gets assigned a 100% stock portfolio, moderately aggressive gets assigned a 90% stock portfolio with 10% bonds, moderate moves to an 80-20 portfolio, then 70-30 for moderately conservative, and 60-40 for entirely conservative. Now, it's important to note that this also depends on your time horizon. So if you're 20 years old and the goal you're investing for is retirement in 40 years, well, an aggressive portfolio might be perfectly fine. But if you're 65 and you plan to retire next year and still consider yourself an aggressive investor, it probably just doesn't make sense to have an all stock portfolio if you're going to start taking income from it. The reason for this decision is this chart right here. So when looking at the all stock portfolio, over a 1-year period, only 82% of the time did that portfolio have a positive return. After that 3-year mark is when you really start to build more confidence with these types of portfolios. Also, this chart doesn't show whether the return was 1% or 30% over that time frame. So what I'd really like to see is the percentage of times that these portfolios beat a high yield savings account or a money market fund, or better yet, just greater than 5% returns, because then I'm sure the number drops. And when you have options like money market funds and high yield savings accounts that are yielding 3.5%, there's just a lot more confidence there when planning for short to medium term goals. Okay, so once we've agreed to a portfolio allocation, we just plug in the portfolio. Now, the funds that I use are VTI, which is Vanguard's total stock market index, and then also VXUS, which is Vanguard's total international stock market. And then I use 2 bond funds, which oddly enough are BND, which is Vanguard's total bond market, and BNDX, which is Vanguard's total international bond market. Let me warn you guys, it gets a little technical here because there's a ton of numbers, but I'm going to throw the portfolios up on the screen. That way you can just screenshot them or take a look at them for later. But I'm still going to talk you through them as well. So the aggressive portfolio ends up 60% VTI, 40% VXUS. The moderately aggressive drops the equity position to 54% VTI, 36% VXUS. And then, of course, now we start to add in the bonds, which is 7% BND, 3% BNDX. The moderate looks like this, moderately conservative like this, and finally, conservative looks just like this. Now, there are 50-50 portfolios and 46 portfolios and so on, but honestly, I don't usually find a need for these types of portfolios unless you're pretty much in retirement, which at that case, there's a lot of other options for you as well. Now, I will also add that at my business, we also have one more portfolio, which I consider to be above the aggressive one because it's a little bit less diversification, and that is a 100% S&P 500 portfolio, which again, we use VOO, but there are plenty out there that you can find. Now, there's a lot more that goes into investment management, especially when managing $1 million portfolios. One thing that comes to mind is rebalancing, but we're going to save that for another video. Now, if you have any questions, you can leave them down below, but until next time, cheers.